the decision made in private that shaped public markets. It happened far from cameras, outside earnings calls and press conferences, in a setting so ordinary that no one present believed they were witnessing a moment that would echo across public markets for years to come. There was no dramatic language, no visible tension, no sense that history was being nudged onto a different path. Only a private decision framed as prudent, technical, and safely removed from public consequence. This story matters today because public markets are often shaped long before the public is aware that anything has changed. We are taught to believe that markets respond to data, announcements, and visible events, yet the forces that truly guide outcomes are frequently set in motion earlier, behind closed doors, through choices that never appear on a chart until it's too late to question their origin. By the time prices move and narratives form, the architecture has already been built. The decision itself did not look extraordinary. It was discussed as risk management, as alignment, as a necessary adjustment to internal priorities rather than a move with external implications. Those involved believed they were acting responsibly, insulating their organization from uncertainty while preserving flexibility in an unpredictable environment. What they did not fully account for was how private constraints, once established, inevitably spill outward into public systems that depend on them. At first, the effects were invisible. Markets continued to function normally. Investors focused on earnings, forecasts, and macro signals, unaware that a subtle recalibration had already altered how information would flow, how incentives would align, and how future choices would be limited or expanded. The decision sat quietly in the background, influencing behavior without ever demanding attention. What made this moment powerful was not intention, but placement. The choice was embedded at a junction where private governance intersected with public exposure, where internal rules quietly dictated external outcomes. From that point forward, market reactions would appear spontaneous, even rational, while in reality they were being guided by a framework no one outside the room had seen. This is how private decisions shape public markets, not through direct control, but through subtle shifts in structure that redefine what is possible long before anyone realizes the rules have changed. And as time passed, the consequences of that private moment began to surface in ways no one could easily trace back to its source. In the early stages, the market absorbed the consequences without resistance, because nothing about the surface behavior suggested disruption or imbalance. Prices moved within familiar ranges, analysts repeated established narratives, and investors continued to interpret signals using frameworks that had worked for years, unaware that those frameworks were now operating on altered assumptions quietly introduced by a decision they would never see. Inside institutions that depended on the structure, behavior began to shift in subtle but measurable ways. Risk models were adjusted slightly. Exposure thresholds were redefined. Approval processes became more layered, not because regulation demanded it, but because a private decision had introduced new internal boundaries that now governed how capital could move. Each adjustment seemed reasonable in isolation, yet together they began to slow reaction times and concentrate influence. What made this especially difficult to detect was that the changes did not distort incentives immediately. They refined them. Market participants still believed they were responding freely, still felt autonomous in their choices, but the range of acceptable actions had quietly narrowed. Certain strategies became harder to execute. Certain positions became easier to justify. Over time, behavior converged toward outcomes that aligned with a private decision, even among actors who had no knowledge it existed. As quarters passed, patterns emerged that analysts struggled to explain convincingly. Volatility appeared in unexpected places. Liquidity thinned where it once flowed easily. Reactions to news felt delayed or exaggerated, as if markets were hesitating, recalculating against constraints no one could articulate clearly. These were not anomalies. They were symptoms. The private decision had reshaped how risk was distributed across the system. What had been diversified began to concentrate. What had been flexible became conditional. And because these changes originated inside governance rather than pricing, they escaped immediate scrutiny. By the time observers sensed discomfort, the behavior had already normalized. This is how structural influence takes hold in public markets, not by dictating outcomes, but by redefining the boundaries within which outcomes can occur. Participants adapt without protest because adaptation feels voluntary, Even when it is quietly compelled, the decision continued to compound, shaping reactions, expectations, and confidence itself. And with every passing cycle, the distance between cause and effect grew wider, making reversal increasingly unlikely. The conflict surfaced when stress finally tested the system, exposing how deeply the private decision had embedded itself into public behavior and how little room remained for genuine flexibility. A period of uncertainty arrived, not unprecedented, but intense enough to force rapid responses. And that was when invisible constraints began to reveal themselves. Institutions that once moved decisively now hesitated. Approval slowed. Capital paused on the sidelines while internal checks multiplied. What looked like caution from the outside was, in reality, friction introduced by rules no longer aligned with market speed. Participants felt pressure without understanding its source. As volatility increased, the divergence became impossible to ignore. Some actors reacted quickly, exploiting gaps and inefficiencies, while others lagged, bound by internal thresholds that prevented timely action. This imbalance reshaped outcomes. Opportunities concentrated among those least constrained, while losses accumulated among those most exposed to the new limitations. Frustration followed. Analysts questioned leadership. Investors demanded explanations. Executives spoke of discipline and prudence, framing delays as intentional restraint rather than structural necessity. Yet internally, conversations grew tense as teams realized that the private decision had reduced their ability to respond just when responsiveness mattered most. The emotional peak emerged from a sense of helplessness rather than panic. People were doing what they had been told was right, following rules designed to protect the system. Yet those very rules now amplified risk instead of containing it. The realization was unsettling. Protection had become vulnerability. Attempts to loosen constraints came too late. Changing them would signal instability. Reversing them would expose past misjudgments. So the structure held, even as its consequences worsened. The system chose consistency over adaptation. By this point, the conflict was no longer theoretical. It was measurable, visible in performance gaps, market reactions, and shifting confidence. The private decision had crossed a threshold. It was no longer just influencing markets. It was shaping winners and losers. And the outcome was approaching, whether anyone was ready or not. The climax arrived when the market finally absorbed what could no longer be disguised as temporary friction or cautious discipline. Under sustained pressure, the system revealed its true shape, and it became clear that the private decision had not merely influenced outcomes, but it quietly predetermined the range of possible responses long before stress ever appeared. What seemed like unpredictable market behavior was, in reality, the natural consequence of constraints embedded years earlier, now activated under conditions they were never designed to withstand. Public reactions followed familiar patterns. Prices adjusted sharply. Confidence wavered. Narratives shifted to explain volatility as external shock rather than internal design. But beneath those explanations sat a harder truth. The market had not failed to adapt. It had adapted exactly as it had been structured to do, following pathways narrowed by private governance rather than public consensus. The resolution came not through correction, but through normalization. Institutions learned to operate within the limits they could no longer change. Investors recalibrated expectations. Strategies adjusted to a slower, more constrained reality. The private decision, once invisible, became accepted as part of the environment, shaping behavior without ever being acknowledged openly as its source. This is why the story matters today. Because modern markets are increasingly governed by internal choices that never face public scrutiny until their consequences are unavoidable. By the time outcomes appear irrational or unfair, the architecture behind them has already hardened into permanence. The true moment of influence has passed, replaced by reactions that feel inevitable rather than chosen. The lesson is not about secrecy or intent. It is about recognizing where power actually operates, not in headlines or price movements, but in the private decisions that define how systems respond under pressure. Those decisions do not announce themselves. They wait, and when conditions finally expose them, the market doesn't debate their validity. It simply lives with them. The decision